Right, welcome back. Let's take a look what's been happening in the markets. Oil extended its recovery from a virus-induced slump as a report showing a drop in U.S. crude inventories, a rebound on Wall Street, and speculation OPEC will step in to prop up prices, reassured investors. Oil has rebounded 1.5% after closing at a 3-month low on Monday amid concerns over the potential impact of the outbreak on travel and economic activity in China, the world's biggest energy consumer. For a look at these and other happenings in the market, we have Nadir Thokan, who is market analyst at 27/4. Thank you very much for coming.
Yeah, thanks for having me.
All right, starting on the local front, how has the JSE been faring since it was heavily bid since Monday?
Yeah, it's been a horrendous start to the week. I mean, it's already been such a volatile year, and we're not even at the end of at the end of January. I'm thinking a quarter ahead already. We're not even at the end of January, and it's already been such a volatile year. At one point in January, the JSE was up about 4.5% on the all-share index, and we've reversed all of that. And in fact, as it closed yesterday, we're down 2.5%. So coronavirus is really biting hard. I think global market participants are very concerned about what impact this has on, one, global economic growth, and two, the trickle-down impact into global company earnings, and as a result of that, we're seeing some risk-off sentiment and money exiting risk assets, and South Africa has just been caught up in that. We've seen the US has also sold off quite a lot, so global stock market indices are flat for the year, but naturally, emerging markets take the biggest hit when these kind of events come to the fore, because capital gets sucked out of emerging markets like a vacuum because there's no appetite for risk. So, I mean, if we look at some of the news that's been breaking so far, Starbucks came out yesterday and said that they're going to be shutting down half of their Chinese stores. I think that will probably be the first real indication of hard impact on company earnings. We know that your S&P 500 companies have been reporting their earnings over the course of the last 2 weeks. In fact, Apple reported their earnings late yesterday after the US market close. We saw that their iPhone sales were very, very robust, but it's kind of just been all overshadowed by the coronavirus and, risk appetite turning really sour. And on the back of that, we're seeing the JSE down, kind of in excess of 5.5% so far this week, although recovering nicely today. So, we'll take heart from that. Global markets started recovering overnight. If you look at the US, and that fed into Asian markets, the ones that were open this morning, and the JSE kind of picking up the mantle on that. And I think encouragingly, we're seeing Naspers up over 3%, and we know that that's probably the JSE listed stock with the most Chinese exposure, given its exposure to Tencent. So hopefully the market can recover off this low and this beat down it's taken so far this week.
So when you look at the oil market, I mean, like the inventories were really taking a slump at a certain stage, but they managed to claw back. And looking at the graph that was made available just to look at the assessment of the performance of the slump, but getting back to its normal rate. For how long will it be able to sustain these levels, looking at how it is actually peaking and then plateauing at the end?
Yeah. So look, I mean, I think that there was some strong oil prices into the back end of last year, and that encouraged a lot of shale in the US to come back online, and that's when we saw the supply glut, and we saw prices coming down. Then towards the back end of last year, we saw supply tightening quite a lot, and into the start of this year, we saw the big escalation of tensions between the US and Iran, and obviously 20% of global oil supply passes through the Straits of Hormuz, and notwithstanding that, OPEC continues to remain committed through the leadership of Saudi Arabia to kind of keep oil supply fairly depressed, and as a result of that, keep prices fairly buoyant. So I think they'll take some heart from that. But all in all, it's very difficult to see how oil climbs above the $65 a barrel for a sustained period of time. And the reason I say that is because US shale operations are phenomenally profitable at those levels, given that the kind of break-evens for a lot of those shale operations are now in the low 40s and the high-quality ones in the high 30s. So at $65 oil, those guys are really printing a lot of cash, and as a result of that, we don't see a significant significant amount of supply being taken offline, and OPEC can try and do that, but the reality is that that supply that OPEC is taking out is just being supplemented by the US shale revolution. So quite difficult to see how absence of significant tension in the Middle East, and basically supply out of the Middle East really taking a battering. So for example, if we were to close the Straits of Hormuz and basically 20% of the world's oil market were blocked, obviously prices would react to that. But in the absence of a big supply side shock, it's difficult to see how oil prices get significantly above the $65 barrel.
All right, just very briefly, the diamonds have been shining at De Beers. I mean, increased sales of 9% and now amounting to 8 billion rands.
Yeah, $545 million at their first site for 2020, and that's a 9% increase from last year, where sales were about $500 million. So I suppose De Beers will take heart from that, and I think most encouragingly, last year we saw rough diamond prices coming under quite a bit of pressure. So volumes came under pressure and prices came under pressure. We're seeing quite a nice uptick in volumes, with it's surpassing that 33 million carat mark for the first De Beers mine where the results were released, and on the back of that, hopefully we start to see a pickup in prices as well for Anglo American. So we remember that Anglo American owns the majority of De Beers in conjunction with the Botswanian government, and we've seen commodity prices in general being very buoyant through the 2019 course of the 2019 calendar year, and continuing this year despite all the risk sentiment. Commodity prices hanging on quite well. So hopefully, De Beers will be hoping that diamond prices can do the same. Although the largest cutter and polisher of rough cut diamonds in India is saying that they're not seeing as much volume as they were seeing this time last year. So maybe that's kind of a sign of where things are going. But for now, I think De Beers will take the 9% increase in revenue, combining with the rest of their business, where Anglo American is actually seeing some strong results on the back of commodity prices, which have been very buoyant.
All right, thank you very much. Let's leave it there. Nadir Thokan is a market analyst at 27/4, and of course bringing us to the end of our market update, and we're going to take a break.